22 S&P target, and it's 4,900, about 5% upside from here. Its proprietary index points to a lot of volatility, though, and they say any dips are a buying opportunity. Let's welcome Scott Kronert. He's U.S. equity strategist over at Citi. Scott, it's great to have you. Why only modest gains?
Well, I think we have to appreciate, the strength we've had in the markets this year as we've kind of come off of the COVID lows set in the early part of 2020. And that strength reflects what we are very clear on is a very strong earnings growth component that's driving the action this year. And our expectation is that for growth to continue into 2022, but at a decelerating rate. So that underscores our argument that, yes, we look for, let's call it modest gains from here. But it's consistent with what we would say still room to go in the economic cycle in this post-COVID circumstance.
You think corporate earnings are going to come down how much, how far, number one, and then what will the multiple that will be applied to that be, and will it be lower than it is today?
Yeah, so it's a really good point, Tyler. So what we're looking at here is a top-down view for earnings per our proprietary measures that gets us to about 8.3%. Which for next year, which isn't far off of where bottom-up consensus is. Now, the way you get there, the path to that earnings growth is a low single-digit growth in the first half of the year, married with stronger, let's call it low double-digit growth in the second half. The way we're thinking about this is that we should expect that gradually some of the supply chain constraints should lift in the first part of the year, which probably provides an earnings tailwind versus current expectations for stocks. And then we have to expect that there's be some second half give back on those growth expectations that end up leaving us in this, let's call it high single digit earnings growth circumstance. Now, critical here is that, the argument is that we're losing the falling rate valuation tailwind that supported the markets in this post global financial crisis cycle, if you will. Mm-hmm. And so here we expect that, if anything, at least less of a valuation tailwind supporting areas of the market like growth, and potentially a little bit more of a headwind.
All right. So are there particular sectors under this scenario that you think would outperform, or what does that spell? Your overall thesis, what does it spell? You've told me 4,900 on the S&P 500, slower growth, yep, but still positive returns. What does it spell for individual sectors? What would do well under these circumstances?
Right. So the way we expect this to play out, again, as we move into the first half, the supply chain angst that we're feeling really strongly right now begins to dissipate. Mm-hmm. And what we're arguing is that this is going to end up favoring the value side of the style ledger. And that's because the economic sensitivity that's typically attributed to value should benefit from the improving sentiment around the relief on the supply chain side. In turn, what that can do is provide more conviction in an extended cycle. So at the margin, your more economic sensitive sectors should benefit. And while growth can certainly play a role in this, mm-hmm, it struggles with a relative earnings growth circumstance versus value. And then it's sort of in the hot spot here in terms of contending with the Fed taper and kind of coming off of the accommodation circumstance from a valuation perspective.
And finally, Scott, tell us about the choppiness that you see, and how does that stack up with what you would typically foresee in a year?
Right. So, our colleague Tobias Levkovich is a difficult circumstance, but he had developed something we call a panic euphoria model that we've renamed the Levkovich Index. And this is a very good, let's call it very strong sentiment tool that right now is indicating that the market's in very much of a euphoric circumstance on this measure. The way we're interpreting this is that this tells us that we should expect a corrective phase at some point in the first part of next year. Now, I think this aligns with the Fed taper and how the market is perceiving steps or missteps by the Fed. So what we're pointing out here is we think that investors have to expect as we go into the first part of 22, the likelihood of a pullback is there. And on our ongoing scenario regarding an extended post-COVID cycle, we want to use such pullbacks opportunistically.
All right, Scott, thanks for your time today. We appreciate it. Scott Kronert joining us from Citi.
And eco